see if I can break it again. But primarily want to thank Terry and Anela for the invitation. I was very surprised to receive the invitation, and I did come up with some pretenses for being invited. So these are my pretenses, and we'll see if they are false or not. So I will welcome your judgment and your contributions. So in relation to Richard's point, well, why am I interested in this? Well, I think I've been interested in wealth and value for many, many years. As an undergraduate in economics, I did try to unravel the world of value and economics, and we can talk about that at greater length later on if there is interest. But anyway, I eschewed the academic life and went into the oil industry, and I learnt a lot about the actually existing economy from oil and business. So starting with wealth, and I'm following in good footsteps. So we have Adam Smith and Marx. Normally people think, oh, Marx started with the commodity, but he didn't. He started with the wealth of those societies in which the capitalist mode prevails is based on the commodities, but he's starting with wealth. So how do we define wealth? It's always good to start off with a definition. And here we have empirical, practical definitions that are not controversial. We have the Credit Suisse Global Wealth Report, saying net worth or wealth is defined as value of financial assets plus real assets minus their debts. And then a recent paper by Alvarado, Atkinson, Morelli. Actually, it was Tony Atkinson's last paper. This was posted in mid-December, and then on the 1st of January 2017 came news of his unfortunate passing. So these are really equivalent definitions, and we have here the academic background, the practitioners studying wealth, but in the first case, this Credit Suisse Global Wealth Report, we have the focus on the high net worth individuals. So a lot of the focus on wealth comes from looking at wealth inequality. So Atkinson epitomizes this. But then we also have the chronicle of it for Credit Suisse and other financial institutions do similar reports. Some of the real estate big organizations like Savills, they will do a global report on the value of property once a year. So there is this dual nature to the focus on wealth, coming from inequality, but also focusing on the very rich. The lineage of... I think we have a problem. Okay. Of course, the modern study, empirical study of wealth, really comes back from the 60s, where Graham Goldsmith in '62 published the first volume on cataloging and chronicling wealth in the United States. And then Jacques Ravel in 1967 did the same for the UK. So really the empirical study and chronicling of wealth is fairly recent. And as we can see, there is this coinciding in the definition of wealth. But how does this relate to value? Well, the definition of wealth includes the word value, but this is the value of assets, a market price. So maybe there is maybe some circularity here. Oh, the amount of wealth is how much it's valued at. So really, are we defining anything here apart from just stacking up people's assets and taking away their debts? That may seem a trivial exercise. But let's look at a bit more depth as to what goes into the breakdown of value. So this is from the Credit Suisse report, looking at the evolution of wealth in the past 20 years, broken down between financial wealth and non-financial wealth or assets. So we can note that the breakdown is more or less 50-50 between the financial and the non-financial. So the non-financial is really in land and buildings, which we can see comes from the past, whereas the financial wealth is coming from the future. So equities and bonds. So these are wealth that we're bringing into the present from the future, expecting this wealth to materialize, whereas the non-financial wealth are what we call real assets. I don't like really this distinction between real and financial, but this is the terminology. So this is coming from the past. So let's reflect a bit further onto this. And I'm using here the value terminology from Capital, Marx's Capital, to look at what I call the two triads of value and time. So we have value is labor time. So this we know we can look at embodied in commodities, and we can measure this, but in a very imprecise way. But it's still the concept of value being the labor involved in the production of commodities. Exchange value is price, so this is the present. When we come to the point of exchange, then we know the price of things. And use value is what we purchase things for their use value. So we can look at this as being value from the past, exchange value the present, and use value the future. So let's go into this a bit further. There has been commentary that use value is being extinguished, that, oh, we're in an age of superfluity, and use value is no longer counting, and we're all, with the excess of goods and commodities, we don't need another generation of trainer or of iPhone or anything, and so use value is being extinguished. I don't think that's the case, but we have to also look at the whole panoply of value, meaning value, exchange value, and use value. And really, there's one type of commodity for which use value is critical, which is that of capital. We don't consume capital in the normal way, but what is the use value of capital? Well, so how do we set the price for capital? We set the price by looking at the prospective yield. So bringing that expected yield to the future, we can come up with a net present value. Now, this is all basic Finance 101 in business school, where this term fundamental value is brought out and then discarded, so that the systematic use of fundamental value is not really pursued. But it's interesting to see that Marx, in Volume 3, completely anticipated this discounted cash flow net present value formulation of fundamental value, where he says capital here appears as a commodity, its use value consists in producing profits, and that you don't look at the value of capital by the underlying value of what the components of capital, but you look at it in terms of how much surplus value, how much profit is going to be produced. So this sets the price for capital. The nice thing about the discounted cash flow NPV measure is that it is unequivocal. How do we measure profits for companies? Well, you can wade through the annual report, and there is a line there for income, but there have been so many transformations made to the cash flow underlying that income that it is not a reliable and unequivocal measure. And this was indicated by the shareholder value school some decades ago, but really they took it from the point of view of business and management, and they were trying to extract more income for themselves. But it really does all come down to cash flow. And it's the only unequivocal measure we have. And if you were to ask the person on the Clapham omnibus how you define income, they would say it's cash in hand. So when it comes to our personal incomes, we know very well that it's cash flow that matters. And so why should companies be any different? We can feasibly measure the cash flow that companies have on an annual basis. The statement in annual reports that now include a cash flow from operations or goes some way towards this. But really the measure of cash flow that I'm talking about is more like a free cash flow that some companies report. So with this perspective, where we can measure companies' incomes on a consistent basis, and we can project this forward into the future, and this is comprising the future component of wealth, which is about half of total wealth. And the other half of wealth comes from the past in land and buildings. So let me try and now relate this to basic income. I've really done some illustrative example, and I have to say I didn't want to delve into the existing studies of UBI. I wanted to approach this fresh, and so I came up with coming for an annual payment of £10,000 for adults, £5,000 for children and teens. This would be an annual amount of 600 billion, but the net cost of this would be about half of this. If you net off the welfare and pension payments that would be foregone, and you factor in extra income tax, and then a bit extra for reducing the government bureaucracy, I think a figure of about half is about right for a net cost. We can now, this might seem odd to you, but I like to convert things to a capital value. So if we take an annual cash flow of 300 billion, we can convert this to a capital value of 3 trillion. And on a per capita basis, it's 44,000. So it is a considerable amount, but total personal wealth in the UK is some 16 trillion. And so a UBI capital value of 3 billion is less than 1/5 of this. So how do we think about bearing this cost? So if we want to focus on the wealth coming from the past, and I think that would be sensible, we don't want to burden future income with this, so we can look at the 8 trillion or so coming into with property and land. We could also look at the charity and not-for-profit sectors, because these are more or less free of any fiscal burden. So the tax breaks and subsidies are both strong and long here. If we take this site here for Downing, and I think I've got this right, that I looked up in the business rates register, and I think Downing pays some 32,000 annually in rates. And the commercial enterprises, of which Downing Conferences is one, and we're at one of their conferences, they pay no corporate tax, not because they're exempt, but because of offsets of the holding trust. So there is this sector of charity and not-for-profit that I think is fairly sizable, certainly in this country and other countries where charitable giving has been established and does get subsidies or tax breaks. So I think that there is scope for looking to these sectors to perhaps contribute, because all the accumulated wealth and assets have more or less been free of any contribution to the exchequer. There is also a big lack of information on this sector, so it's not an easy one to go into. So I want to sum up, and first of all, I have to agree with Terry that money is the most important fact in economics. He often says this. I've only met him once, and he said it a couple of times then, and then I saw him on a seminar a month or so ago on the Cambridge, what was that, the book that was recently published, and you said it again, Terry. So I have to agree with you, money is the most important fact in economics, and this underpins my view of value and wealth. And you can't conceive of a cash flow surplus without conceiving of profit. And I think those are also goes the other way. You can't think of having a profit unless there is a cash flow surplus. So very simply, we project a cash flow surplus into the future and discount it, and gives a net present value, a price of capital. So we can see wealth as being a function of future income and of past accumulation. Obviously, we have to know how we convert future income into a capital value for wealth at present. And we also have influences on land and property that are changing the valuation of this over time, representing the component of wealth from the past. But these are future studies to be done, and there are always things to be updated. But last of all, how do we see this for UBI? Well, we can see UBI as being feasible for the UK, and I think why not go for a maximum UBI? 10,000 a year is, I think, probably about the right level that would ensure the effects that we're looking for. I had thought about making it equal to the tax-free band, which is, I think, 12,500, but I thought, no, let's give a bit of headroom so that people, in addition to their UBI, their first couple of thousand of income will also be tax-free. So we can also target the wealth from the past for bearing the cost for UBI, and we can also look at the accumulated wealth in charity and trust to perhaps provide a bit of extra help. So on that, I hope I've at least come up with some of the fulfillment of my initial statement, and look forward to questions and then later discussion.